Hi, happy Wednesday, everyone. Welcome back to Beat University. I'm Ashley SWARTZ, CEO of Furious Corp and Dean of the Beat faculty. I'm very excited to be here. Thank you to Andy and Katie and the crew, my family that is unfortunately still afar and virtual. But we started this as our 7th class, believe it or not. And we started this sort of a few weeks into the crisis, this COVID thing, because we really just wanted to create a little bit of lightness in the darkness, right? And just offer some light, if you will. And in doing so, create an educational curriculum for those new to the industry, those titans maybe that are home, to brush up and sort of, just talk about the industry and to reinfuse rather the lexicon of the industry back into our conversation, so that we all have level setting as to definitions and meanings, so we don't get hung up on vocabulary anymore, if you will. We spent the first 4 of these 7 basically using this companion piece, which was a TV and video dictionary that Furious Corp had created. The URL's on the screen. Andy also just has distributed it previously through his Beat audience. But it really is sort of a set of definitions for the industry. It's a great basis of fundamentals, and that is the foundation from which we're having these more advanced conversations now in the latter part of the semester, if you will. So if you want to go back and brush up on the first 4, it's great to do that. You can do that at the website that is now showing on the page. They're all there, or they're on the Furious Corp website. Either way, we hope that you find them useful, and we're excited for you to be here. So I've gotten some incredible feedback from folks and a lot of great support, so thank you for that. And one of the things that a few folks have asked me is, Ash, we know you're sort of not, your background is not necessarily advertising and marketing for the beginning of your career, and you use this phrase portfolio optimization a lot. What do you really mean by it? And so I thought I would spend today talking about portfolio optimization and deconstructing it a bit, and really diving into it and taking that from the lens of sellers, because so often when we talk about optimization in our industry, we are quite often implicitly talking about the buy side, right? It's media mix modeling, it's attribution modeling, it's optimizing the value and ROI of every dollar spent on media. And ultimately, what I want to talk about today is actually maximizing the value of a portfolio of media assets for sellers. Because as you guys know, I believe sellers are grossly underserved in our industry. And I believe that quality starts at the top and works its way down through the value chain. So, I think helping sellers, particularly during these incredibly challenging and disruptive times that we're in with this reset, is part of our responsibility, and something that I take as a responsibility of my own. So I'm excited to have a forum to talk about it. So if we sort of start about, what and why we want to talk about portfolio, the why and the what rather of portfolio optimization. Well, so I think it's important to know context. So my educational background is finance. I spent a lot of my career in finance, but I worked in manufacturing finance in particular, right? So when I first started and I learned about sort of portfolio optimization, obviously my financial education, but then really in a meaningful sort of tangible sense when I was in manufacturing. So when we talk about portfolio optimization from the perspective of sellers, we're often referring to the optimization of their product portfolio, products being different types of advertising products, right? So really, what is that in the context of advertising and sellers? When we talk about just sort of, product portfolio management, it is really about taking all of the sort of existing products that you had and that product mix and marketing it, packaging it, merchandising it so as to maximize the revenue potential, right? Portfolio optimization starts from the analysis, the aim of which is to collect all the necessary data and inputs to determine the potential as well as the strengths and weaknesses of particular products. So your products kind of become levers that you pull or you push in order to ensure that you are maximizing total revenue, right? And products, let's say if linear, which we'll get into, is kind of an asset class, right? Products are general linear interconnect, linear addressable, linear national, et cetera, right? And we really, I think, sort of, need to kind of contextualize it in that sense. So portfolio strategy should be informed by clear financial objectives and goals, right? And that's important for any seller to have, but particularly if you want to start really running your advertising business as a portfolio, right? So when we're evaluating and we're scenario planning in consideration of the introduction of new products, particularly those that require significant capital investment in infrastructure, technology, and data, like addressable, right? Or like over the top, or sort of connected television products and platforms, right? We really have to have an understanding of decision factors as to whether to greenlight an investment or the expectation on the return on that investment in order to introduce a new product into our portfolio. It's really critical for sellers or anybody, right? But to understand the true cost of a new product, it is essential that sellers know ultimately whether or not revenue from new products is going to be profitable revenue, right? And importantly, the level of margin that a new product will contribute to the overall advertising business and its portfolio. And that's really important because, we've sort of with digital, we've oftentimes chased just sort of new objects, right? Net new. We looked at revenue growth, but ultimately digital, particularly because of the ad tax in that middle of how much ad tech and data and all the things that are enabled, those value added products and services and technology in the middle is required to deliver sort of the digital ad products today that we've come to expect. Ultimately, digital is more profitable. Digital is a new product. It requires investment. So you can sort of see why it's important to really understand through the line, not only are we maximizing portfolio total revenue, we want to also understand whether or not our portfolio is profitable, particularly more or less with a different product mix or the introduction of new products. So, given that overall financial performance is the goal, a seller's mix of products can be likened to assets, I sort of mentioned before, right? In which we invest in those assets to achieve a set of financial goals. So I want to sort of, I want to pull on that thread, right? And I want to see how I want to talk about managing an advertising product portfolio is similar to managing an investment portfolio. Because I think many of you, perhaps, you all have retirement funds, or you understand that maybe more, that this idea of a portfolio optimization. So let's talk about how portfolio optimization in media is similar to investing in securities and give it that context, right? So I'm going to unpack that a little bit today. Let's start by defining this portfolio again, just as sort of a level set, right, from the media lens. It's simply the aggregate of a seller's inventory, right, of products and formats in which inventory is offered, specific at any currency, right? So spots, points, impressions, etc. So you can think of each format as an asset class or platform, right? So in finance, we have stocks or equities, we have bonds, we have commodities, etc. While in media, we have linear television, we have over the top, we have, sort of web or mobile, right? And these are classes of assets. And then ultimately within each of those asset classes, there are different products. Like if you have equities, you have a stock, right? You could buy Apple or you could buy Amazon. The same with linear, you could choose to sell linear direct or addressable with the same sort of core inventory itself. So, the reality is that you don't make the most money or manage risk by focusing on only one set of assets or one asset class, if you will, right, to the exclusion of all others. And that's the key. So instead, investors, they try to maximize the entire portfolio by finding that right mix or that right, that sort of right asset class mix, and then allocation to deliver the highest risk-adjusted return. This is really important, right? So similarly, every media seller's obsession should be, or it is, right? But it should be to packaging and pricing their inventory in a way that it maximizes their yield, right? Or the total revenue available across all of their pools of inventory. And so this is where the churn and the work comes into actually understanding and having a clear sense of how your portfolio is performing, and then being able to look into the future to scenario plan or analyze how it would perform differently if you change that product mix. So the best practices underpinning portfolio optimization for media and financial services, they're really similar. We've kind of established the foundations, right? The financial principles, that are used can be really valuable and instructive, and a great reference for TV sellers, both networks, distributors, local broadcasters as well. And so I thought that it would be really helpful to maybe take best practices and sort of the best practices of financial investors and contextualize that for media, and see how, you could frame out a sort of playbook to approach portfolio optimization. Core tenet in managing a financial portfolio, which can be applied and contextualized for media, is to hedge your bets. So fundamental, tenets of investment portfolio strategies include allocation among different asset classes, as we've talked about, right? That modulates risks and hedges bets. It's also why sort of even investors that have a high tolerance typically have some debt securities in their portfolios, right? In fact, debt is typically held in a portfolio regardless of where the investor is in their investment time horizon. So when we say time horizon, I think this is also really important in the context of media, right? Because we talk about sort of new media, old media, right? Traditional media companies like the broadcasters of the world or sort of operators, they have these core tentpole assets, these anchor assets, which are linear television assets. And then ultimately they have continually expanded either through acquisition or investment in new platforms into new asset classes like digital, over the top, right? Things like that, or mobile. And regardless of sort of where they are in their state of maturation or evolution as a company, they're still going to have that anchor, what is likened to debt sort of investment in television. That is still going to be a core foundation of their portfolio. And then what's interesting is the pendulum swings the other way, because new and digital companies, particularly digital video, they are all trying to in some way get indirectly or directly into the television business, because they also need an anchor in their portfolio, which is sort of how debt behaves in financial portfolio's. Debt investments carry less risk, right? They also often offer a lower return potential than equities, but they sort of serve to protect the portfolio from volatility. That's why they act as a hedge, right? So debt provides a tentpole that generates consistent, reliable income, and people tend to hold debt even when it's underperforming relative to other asset classes. Sound a little bit like linear television, right? So it may not be growing, it may not be delivering significantly more revenue year over year, but it's probably consistently profitable revenue, and it's reliable revenue. And that's actually why it remains a tentpole for many large media companies' portfolios. The second thing that investors, financial investors often do, and they do actively, this is an active process for them, and quite often why I, for example, have a financial quarterback, I have a financial advisor that manages my portfolio, and the little money that I have that I invest on my own, I use typically ETFs, no longer mutual funds, but mutual funds are also an option. But I use someone or something, a machine that can churn a lot of data and do a lot of analyzing on that mix to help me invest my money smarter, right? And to predict what my return on investment is going to be. So the rebalancing of a portfolio, or your portfolio in particular, is critical. So smart investors adopt asset rebalancing as a strategy because it reduces the effects of market movements on the desired allocation, right? So it sort of also helps mitigate for volatility in the market. So asset rebalancing calls for having a target equity to debt ratio. That would be a product mix, if you will, if you were a seller within the investments, and periodically reconsidering the allocation in light of portfolio performance and market factors. And then ultimately adjusting it to ensure that the desired balance is maintained so that you can predict the return on investment, or at least hang your hat that you're going to get a return on that investment. So when equities perform better than debt, you should sell some equity investments and invest the redeemed value in debt to rebalance your portfolio, and vice versa. So this prevents you from taking on more risk than you intended, right? This is a lot like global inventory allocation for sellers of television. And typically linear television as an asset class with different products, the mix or the allocation of that portfolio to each of those products is quite often what we call a rigid carve out or a hard carve. They sell these units in this specific quantity as this product for this period. Set it, forget it. And so ultimately, that inadvertently means that portfolio management is a passive sort of strategy that is just not embraced or adopted or implemented by a lot of sellers of linear television. So TV sellers should really be monitoring and rebalancing their portfolio, each year to respond to changes in demand, particularly in predicted demand, and to keep their risk in line. And then not just annually, but do it more frequently, right? As frequently as you possibly can get that information and the feedback from the market and from your systems to understand, and with confidence be able to analyze and predict what scenarios would be. So it calls for periodically assessing the relative contribution of each ad product category to total revenue, and then rebalancing available inventory allocation. And this ensures that advertising clients are being well served and that the greatest total revenue is achieved during that period that's coming up, right? So, you need to have a handle on your data, which we'll sort of talk about in a minute or two, but really you need to have that data, and you need to have a sense of what the future looks like, particularly to predict future demand, to be able to run scenarios and analyze to ensure that you are serving the demand first and foremost and serving your clients, but then ultimately ensuring that the value of your inventory is maximized as to the greatest extent it can be. The next thing that's really important, which I personally have a sort of soft spot for as a financial person, is that high price does not equal high profit. And we seldom talk about profitability in our business. And I think that is so unfortunate. And I think that's actually a little bit of laziness as the result of the fact that, traditional media has been very profitable businesses, right? It hasn't required a ton of technology. There really hasn't been an ad tax or intermediaries in television or other traditional media sort of inventory types like radio. So, we haven't talked about profitability because it's just been profitable. And ultimately, you'll maximize your yield as a seller by hedging your bets, but in the same way you maximize your holdings as a financial investor. But at a high level, this means not blindly over allocating to a shiny object, right? Which is typically high risk, high return, just because it fetches the highest price. And that's actually really important, right? So when we talk about it in the context of sort of selling, right? Quite often, if we start by looking at revenue and then we assess profitability, if we ever do. And ultimately what ends up happening is that when we look at things like addressable, immediately we see that the value of the inventory when packaged or sold as an addressable product in lieu of a traditional linear product, it is more valuable. And so by selling all the addressable inventory you can, for example, you could end up cannibalizing other valuable parts of your portfolio. Straightforward, common example we see is that primetime spots that lose their Nielsen eligibility because addressable units have been cherry picked and there's no longer enough critical mass for them to sell, right? So over indexing on the highest risk, highest return asset is fundamentally not a sound strategy. Sellers need to manage their individual assets, right? So their ad products, for example, more actively, and they need to ensure that they're optimizing the value of that portfolio, and they need to act more like investors, right? As much as sellers, but also investors. It's a different mindset and a different way of operating, but it's going to deliver much more shareholder value and ultimately create sustainable profit that is going to allow you to invest in those new products that are identified that could be profitable and could further continue to enhance and increase the value of that portfolio. So let's just talk about kind of the actual action planning, right? So what are 3 tenets of portfolio optimization that every seller should know? So just kind of like these check boxes, right? We've talked about sort of principles of investment strategies or principles of portfolio optimization. Now let's talk about how you actually do it and you let the rubber meets the road, if you will. So ultimately, optimizing a portfolio as a seller in media requires continually assessing relative contribution of each ad product and each asset class to total revenue, and then rebalancing that inventory and reallocating that inventory both at a global level, i.e. by product, and then ultimately unit by unit, impression by impression, spot by spot, etc., to ensure that clients are well served and revenue is maximized across the portfolio. So this approach is just so different, right? It's different muscle memory. It's a much different way of operating. It also requires a new set of tools, right? It's more subtle. It's more dynamic. It's more real time. It's not just selling a tranche of inventory for the highest price it will fetch. It's predicated on the idea of hedging bets and not going all in on shiny objects by default when demand is high. So, there's sort of 3 principles that I think that your organization needs to live by if you're a seller to make your portfolio optimization strategy a success. I think the first is really got to break down the silos. The thing is that portfolio optimization is as much about EQ as it is IQ. And right now, that means the people side of it, the people factor, emotional intelligence, right? So, most sales organizations, most advertising sales organizations, particularly large publicly traded media companies, they're breaking them down, but they've really had a digital team, they've had a linear team, et cetera. And for portfolio optimization strategy to succeed, teams and individuals need to be incentivized to work towards the same revenue goals. They have to have a shared set of goals and common goals that have been set at the organizational level. Organization being advertising sales, not a digital advertising sales P&L, not a linear line of business, et cetera, right? And a lot are still siloed, with teams solely dedicated to sort of linear or solely dedicated to digital, et cetera. And that really actually ends up ultimately undermining portfolio value and portfolio optimization. And the reality is you can't hold people accountable for portfolio performance. I mean, you can make it 25% of their bonus or their sales incentive packages. How does the entire ad business perform? But it's not fair to hold them accountable if they really can't actually, they don't have the tools, the visibility, or line of sight to be able to influence portfolio value. And they're not prescribed what success is for the portfolio. So if digital salespeople's core compensation and bonus are predominantly tied to how much digital inventory they sell, they're probably going to be laser focused on digital at the expense of all else. That's a great example, right? Many would even think of growing their business for digital at the cost of linear, right, is a good thing, because that's the growth business. But when silos are brought down and a large share of comp packages are tied to portfolio value, salespeople become less territorial. And salespeople are human, right? You hire them because they're hungry, they're dog on bone. And they're more likely to work collaboratively and make decisions that result in inventory being sold for its true value. And that's really what you want at the end of the day, because everybody is ultimately incentivized to get as much as they can for all the inventory available for sale. The second tenet is to prioritize data management. So your organization has troves of data, a lot of probably which is not easily accessible or used in making decisions or in analyzing the portfolio value of your media assets. But ultimately, what ends up happening when you tap into that sales data, this historical sold inventory, right? Rate cards, programs, day part performance, how it was productized, how it was packaged. It helps bring the true value of the inventory to light. But this all needs to be accessible, and you need to be able to find the signal and the noise. So it needs to be cleansed and normalized to provide the necessary visibility. It means that data management and transformation have to become core competences within your enterprise. But that should not be overwhelming. You don't have to change the DNA of your organization. If you're a media company, you don't have to become a technology company or a data management company, right? It shouldn't phase you. There are so many folks and partners out there, systems integrators, data management companies, et cetera, that you can rely on. If not, if you don't have the competence from within, or speed is a factor, et cetera, you don't want to build the teams, you don't have to build it bottom up. You can select external partners to help you get there, and then ultimately implement your IT infrastructure strategy. The one thing I will say, though, is champagne taste and a beer budget will always bite you in the bum. Go in eyes wide open. We have heard of so many clients and encountered so many clients that endeavored upon their data management strategies, building their data lake or their data warehouse or their data mart or their data pond, or you name it. I would like a swimming pool right now, to be honest. Summer's coming. But they've endeavored upon that with, sort of minimal budget. And then ultimately they've ended up having to spend 10x that and find a new partner because they just went with the lowest cost bidder and didn't actually look at what their enterprise needed to be able to have that line of sight to run their portfolio and to optimize its value. The third tenet is to work on making progress towards portfolio optimization measurable, quantifiable, right? Introduce quantitative metrics that your entire organization, from account executives to ad trafficking to senior leadership, can tap into quickly and understand the progress towards goals and towards an optimal portfolio, and sort of be able to track that, right? Consider, for example, a KPI like inventory efficiency, to be measured for every dollar of your top 20 clients only. So think about sort of narrow casting, right? And actually having laser focus on metrics and KPIs that are easy to understand and are easily digestible. And so when people look at them, they're not going to immediately throw 3,000 sort of wrenches into the conversation as to, well, why that metric doesn't make sense or why that data doesn't make sense. Clear, straightforward, laser focused, and easily quantifiable. This is what gets into really sort of the change management, right? It's hearts and minds, because you don't want to just change the way that people act. You want to change the way they think. And so you have to shift employees' behaviors and develop a totally new set of muscle memory, right? You have to change the muscle memory that exists within your advertising, sales, and even ad ops organizations, and pricing and planning, right? So you need to make sure that people at all levels and functions understand the focus on portfolio value. And that becomes the central sort of conversation when we talk about performance and success, and we need to shift away from business as usual, right? For example, just selling inventory at a certain price because that's the way it's done historical, or your rate card is last year's rate card plus or minus 200 basis points, right? Depending on what your gut is about demand. So when I talk about muscle memory and changing the way that people think as well as act, what I'm really saying is that you have to want your people to focus less on revenue secured and more on revenue left on the table. That's how you optimize portfolio value. We have been net new, right? Digital advertising, has been the growth medium, particularly digital video, time spent, and mobile as well. People are multitasking, but like I've said this in 20 different presentations in the last 3 years, we are tapped out. The one thing we all have as human beings that makes us equal is the same amount of time in the day, 24 hours. And right now, estimate is we spend 12 hours and 8 minutes a day consuming media of some sort, sometimes on multiple devices. You add in all the things you got to do in a day, there's not much time left. So there's not net new growth in time spent. It is now about share shift. And so ultimately optimization, particularly if you have a large and a broad portfolio of assets, will require that you are more efficient in identifying where there is inefficiencies, gaps in capacity, opportunities to do more with the same. That's how you're going to really maximize and see incredible results from making portfolio optimization a core way that you run, a core sort of principle with which you run your business. And if you're going to do it and expect your teams to do it, and you have that groundswell from within the organization, and you want everybody to sing from the same hymn sheet, you got to give them tools and you got to give them visibility. So transparency and sort of access to information and the tools with which to visualize information. And most importantly, retrain this sort of how data is used to drive decisions and to make better decisions will be key in sort of effectively shepherding this transformation to a portfolio optimization DNA within a media sales organization. At the end of the day, every seller should be focused on packaging and pricing of inventory. That's sort of a given, right? And in ways that maximize yield and total revenue from the entirety of that pool, of their pool of inventory. It's a fundamentally different way of doing business, but if it's done right, and this is again, why I love math and I love data, because it doesn't lie. And the data proves time and time again, when we have analyzed many sellers' historical sales transaction data, there is an immense amount of revenue leakage or money being left on the table, particularly because the business is not being managed holistically as a portfolio. Things are not being done to hedge volatility or variability and to manage it and mitigate risk. And then lastly, because ultimately data is not being used to drive decisions and to allocate inventory and manage your product and portfolio mix. So there is nothing but opportunity here, simply waiting to be unlocked with the beauty of data science, and math. That's a lovely narrative, and that's a happy ending for me if I've ever heard one. That and Hallmark Channel are sort of the best I got to offer you. So thank you for coming to Class 7. It's always a pleasure. We have a long weekend coming up in the US, which is amazing. So I hope everyone gets to enjoy it, spend some time, and ideally be outside. We'll see where we end up after this long break. But I wish light to all, love to all, and peace to all. Thank you, guys.